Doing nothing breaks stuff. Asset monetization sounds like middle ground. It's not. It swaps tomorrow's predictable money for today's one-time cash. Your grandkids still pay, but their money flows to a fund in New York, Sydney, Toronto, or Abu Dhabi. And once you do one deal, budgets rely on fees you no longer control. Parking drops, you might owe the operator. A pandemic clears streets. Force majeure carve-outs still spark fights. Heads, investors win. Tails, they negotiate. So cities keep doing it because the gap is real and time makes it worse. Inflation lifts wages and asphalt. Ratings watch pensions like hawks. Markets jumpy. Refinancing spikes. The biggest check starts to look like the only door out. This is the cash crunch machine. Pressure in, options out, contracts lock. To see it in the wild, look at the blueprint, Chicago's parking meters. Let's walk through it next. Case Study 1, Chicago's 75-year parking meter deal. 3 days in December 2008. Thick ordinance Tuesday, briefing Wednesday, vote Thursday. 40-5. Chicago handed control of 36,000 meters to a brand new company for 75 years. Check. $1.16 billion. People thought it fixed things. It didn't. Other side. A Morgan Stanley-led consortium with Allianz Capital Partners and the Abu Dhabi Investment Authority. They formed Chicago Parking Meters, LLC right before close. New shell, serious money. Their math, projections north of $10 billion over the term. By cash flows cheap, lock rising rates, let time work. Why sell low? Speed, pressure, bad assumptions. A steep discount rate, short horizon, thin credit for tech upgrades. The Great Recession cratered revenues. City Hall needed cash now. Consultants said market value. The market said steel. The contract was Tripwire City. Close a street for a festival? Pay true-up for lost hours. Add a bus or bike lane that removes spaces. Pay. Convert to loading? Pay. Construction and broken meters triggered math too. Policy events, routine repairs, each could spark an invoice. You can govern, but you pay rent on your own curb. Rates jumped fast. Coins to pay boxes to phones. No grace minutes, tighter enforcement. Collections surged by design. The operator invested in gear that turns minutes into money. Prices rose on a schedule tied to inflation and pre-agreed hikes. Households felt it. Lunch crowds felt it. Budget side. Most of the $1.16 billion plugged deficits and short-term debt. A reserve got tapped later. A few years of relief, then the same gaps, pensions, maintenance, ops. But the city had traded away a steady stream that could have helped. Sugar high, then crash. Backlash was loud. People hated the speed, the spikes, the ironclad terms. Lawsuits flew. Unwind it. Not really. Termination penalties were massive, lenders were lined up, and tweaks took years. By the early 2020s, investors had recovered principal and were hundreds of millions into profit. 60-plus years still to go. Micro moment, a neighborhood block party. Permits okayed. Then an invoice, pay for each metered hour lost. That bill used to be zero. The choice, cancel or fundraise to cover curb rent. That's a balance sheet on a sidewalk. The real loss was freedom. Remove parking to add bus-only lanes? Each lost meter costs. Outdoor dining in a crisis? Same. The deal didn't ban moves. It priced them. Tight budgets turned price into veto. Finance took notes. The deal became a roadshow slide. Stable, inflation-linked, must-pay revenue, rate latitude, enforcement, legal shields. Template portable. If meters monetize, so do tolls, airports, water, sewers. Chicago was the test. Returns made it a billboard. Could it have been better? Shorter term, revenue sharing above a baseline, more time for bids, and carve-outs for festivals, bike lanes, transit. But the clock and incentives pushed speed. Advisors earned success fees at close, not on lifetime value. Bigger lesson. Long leases don't just privatize cash, they privatize choices. Councils inherit contracts, not clean slates. Ideas hit a spreadsheet first. If compensation kills the line, the idea dies quiet. By the time the math was clear, the river had changed course. Money that once washed into parks, libraries, buses now flowed to funds far from the curb. Meters kept blinking. Invoices kept coming. Then the template moved to bigger pavement. Parking was the pilot. Toll roads were the rollout. The toll road gold rush. While Chicago's meters printed money, the big game moved to highways. Must-drive roads with toll booths that never sleep. First big splash, Indiana. In 2006, the state took a $3.8 billion check for a 75-year lease of the 157-mile Indiana toll road to a Sintra, Macquarie joint venture. Quick cash and a promise. Private know-how, better service, predictable tolls. Under the hood, toll escalators baked in. Some tied to inflation, some on an annual schedule. Revenue pointed up even if traffic was flat. For drivers, higher tolls like clockwork. For investors, a bond-like stream with a ratchet. With that floor, operators levered up, paid early dividends, and refinanced when credit was kind. Leverage cut back. Traffic lagged, debt costs bit. In 2014, the operator filed Chapter 11. Headlines screamed failure. But the model held. In 2015, IFM investors paid $5.73 billion for the same lease. The road didn't change. Cash flows got repriced up. Public saw collapse. Finance saw mark-to-market. The Chicago Skyway echoed the logic. Pay big, raise tolls within caps, rework debt, skim the spread. If you borrow cheaper than the road earns, you pocket the difference. CPI-linked tolls keep pace. Not sexy, just math. Drivers felt the grind. Prices crept, transponders replaced cash, late fees got sticky. Miss a toll, get letters, then penalties, then suspension risk. Thin budgets had no way around it. You need work. You pay the gate. If you can't, the meter runs against you. Freedom traded for cash. Divert trucks to cut neighborhood noise? Non-compete can trigger payouts. Cap tolls in a recession. Change in law claims. Even lane closure planning becomes a negotiation because closures shift hourly revenue. Policy isn't banned. It's priced. Bankruptcy didn't end the story. It reset it. The road stayed open. The contract survived. Lenders took a hit. A new investor stepped in at a higher valuation. The state kept the first check and the locked terms. Little incentive to rethink. The market learned. Tolls are durable through storms. Microstory. A nurse in Gary works nights. 2 plazas a day. In 2006, a few bucks. By the early 2020s, hikes pushed her monthly tolls past her phone bill. Groceries tighten, a birthday dinner skipped, the gate still gets paid. That's must-pay on a fridge. Calendar. The sales deck toward state houses. Monetize today, build tomorrow. Undermanaged roads, optimized ops, transparent rates. The real engine. CPI escalators, heavy leverage, refi optionality, legal shields. Heads, you harvest. Tails, the asset trades up. Better structures? Yes. Shorter concessions. Share revenue once returns clear a hurdle. Hard caps on escalators. Clawback refinancing gains. Real KPIs, not shiny restrooms. Public finance options over one-time jackpots with strings. This wasn't a one-off. It rolled out a model built on patience and pricing power. Investors brought a 40-year clock, governors a 4-year one. Same as meters. The highest cost wasn't only higher prices. It was losing freedom to steer without cutting a check. Water, sewer, and the bill you can't skip. You can dodge a highway. You can't skip the tap. That's why private equity loves pipes. Monopoly service, must-pay bills, inflation passed straight to you. Cash flows even in recessions because people need to drink, flush, shower, cook. Miss a payment, and the shutoff notice has teeth. See Allentown, Pennsylvania. After the Great Recession, pensions climbed fast. In 2013, the city leased water and sewer to the local authority to plug a pension deficit. Upfront cash now, future rate power moved to a contract. Within years, double-digit increases hit. Not a glitch, a feature. Why spikes? Steady escalators plus capital recovery charges. Cities deferred maintenance for years. Private operators inherit worn pipes, then upgrade plants, mains, meters. Those costs flow into your bill as capex recovery, sometimes with a return. Yesterday's deferral becomes today's surcharge. Enforcement is stronger than tolls, shut-off power. Collections jump when your tap is on the line. Late fees stack. Payment plans add admin charges. It turns a basic service into a prime receivable. Service disputes live in the contract. Brown water, boil orders, backups. Penalties may be cheaper than fixes. Operators point to compliance. Cities point to promises. Meetings become spreadsheets with lawyers. Microstory. A diner owner on Hamilton Street. A winter main burst kills morning pressure. Coffee machines stall. Breakfast crowds thin. The crew shows in the afternoon. He loses a day, then sees a capital adjustment on next month's bill. He pays. You can't fry eggs without water. Climate adds cost. More storms, overflows, treatment needs. Resilience, bigger pipes, green infra, backup power matters. Under private control, it's a decades-long revenue engine via tariff formulas. ESG wraps it nice. Math still lands on your table. Equity risks hide in base fees. A retired couple pays the same fixed charge as a big home before a gallon flows. Miss a month, fees pile up, a door tag warns shut off. The city hotline can't help, contract rules. Terms are sticky. Change in law clauses can bill the city for lifeline protections. Winter shutoff moratorium? Claim. Leak forgiveness? Claim. Policy isn't banned. It's priced again. Funds pile in because demand barely moves in recessions. Inflation bumps? Tariffs adjust. Debt loves the stability, so operators lever up, pay dividends, and roll maturities. If rates rise, they push more into riders and base hikes. It's the toll road model without traffic risk. Better paths. Public-public partnerships paired with low-rate state revolving funds. Shorter concessions with clawbacks above a return hurdle. Real KPIs, outage minutes, leak loss, auto credits. Lifeline tiers that cut base charges for low users. Transparent audits and open data. Truth, public control doesn't make leaks free. But when the city holds the lever, councils balance price and policy without a termination invoice. They borrow cheaper than private equity's hurdle and choose equity over extraction when storms hit. Allentown's lesson isn't no investment. It's better terms. When yield drives design, your bill is a profit plan. When stewardship drives design, your bill is a public choice, argued in daylight. The water flows either way. The question is where your money goes. The rise of shadow banks in city finance while pipes and tolls turned into yield machines, something quieter slid into City Hall. Lenders you don't see on Main Street. Not big local banks. Private credit funds. Infrastructure debt shops. The shadow banks. They don't take deposits. They raise money from pensions and endowments, then write loans that look simple on paper and heavy in the footnotes. Cities started calling them when bond markets got picky and timelines got tight. Here's why they're attractive in a panic. They move fast. No months-long roadshows. No retail buyers to convince. They show up with a term sheet that says we can close in 30 days. But flip the page and the price of speed shows up. Revenue-backed loans tied to a single stream. Parking, solid waste fees, water taps, even court fines. Covenants that kick in if revenue dips. Step-up interest if rating slips. Prepayment penalties so steep you're married to them longer than your mayor's term. A budget director in a mid-sized city told me how it lands. Sales tax came in light. A bond refunding fell through. Payroll was days away. A private credit fund slid a proposal across the table. A $150 million loan secured by sanitation fees, senior to other claims, with automatic sweeps from the lockbox before a dollar touched the general fund. The rate? A few points above muni bonds. The catch? Call protection for a decade and covenants that forced rate hikes if coverage fell. She signed. "Trust me on this one," she said later. We felt cornered. Meanwhile, something else was happening in the back office. Fees that used to be paid and filed, parking tickets, camera fines, court costs, got bundled. Securitized. Think of it like a box of IOUs from thousands of drivers and defendants, turned into bonds and sold to investors hunting yield. Structure promises steady cash because late fees and penalties fatten the stream. If collections lag, servicers add pressure. More letters, boot trucks, credit reporting. It's clean math for a spreadsheet. It's a mess for a single mom juggling 2 jobs and a busted taillight. Shadow banks didn't stop at fees. They pushed pension obligation bonds, borrowing to invest. The pitch goes like this. Your pension is underfunded. Your expected return is 7%. Muni rates are 3 or 4, so borrow cheap, dump it in the market, earn the spread. It works until it doesn't. If markets dip, you owe debt service and still have a hole. Rating agencies warn, but advisors earn success fees when deals close, not when retirees get paid in 2040. Optimism bias creeps in. The spreadsheet wins again. Ratings matter here. A downgrade on the general fund can shove a city toward these private deals. Traditional muni buyers want clean coverage and simple liens. Shadow lenders accept hairier structures if they get control, lockboxes, flow of funds waterfalls, springing reserves. Miss a test, and the loan rate steps up automatically. Miss again, and the lender can force rate increases on the pledged revenue or sweep more cash. You don't feel it at City Hall first. You feel it when your trash bill and parking fines jump in sync. Here's a microstory. A college kid racks up 2 camera tickets and forgets to pay. The city sold a slice of traffic fine receivables into a trust. The servicer flags the account, slaps on late fees, boots the car. He pays the tow plus fees on a credit card. 3 months later, he sees a ding on his credit because the account rolled to collections before his payment cleared the trust's monthly cycle. 1 streetlight, 1 camera, 1 missed email, and now his rent costs more. Meanwhile, advisors and rating analysts often live in the same small circle. Consultants model demand with rosy assumptions. Lenders underwrite to strict covenants to hedge that rose. The city sits in the middle, relieved to close, unaware that they just pledged next decade's wiggle room. Unknown to them across town, the council is debating a transit fare freeze. If the bus system's fare box is pledged under a revenue-backed note, that freeze can trigger a default test. Suddenly, policy is a spreadsheet alert. Pension obligation bonds deserve one more beat. Their leverage, plain and simple. If you borrow $1 billion and the market returns 8% for 5 years, you look like a genius. If it drops 20% in year 1, you're underwater while paying fixed coupons. That pressure pushes cities toward more creative revenue pledges to keep ratios pretty. It's a quiet loop: debt to fund investments, then debt to fund debt. So why do shadow banks flourish here? Because they solve real timing problems and price risk with terms, not headlines. City leaders prefer pain tomorrow. Funds prefer control today. The spread lives in that gap. And traditional banks? After the 2008 crisis, many pulled back from complex municipal lending. Private credit filled the lane. Could cities push back? Yes. Standardized term sheets. Then pledging basic fines and fees that drive regressivity. Use state revolving funds and public banks for bridge loans with transparent costs. Demand independent valuations without success fee bias. And publish loan covenants in plain English so voters see the strings. The larger point is simple. Even when you don't sell an asset, you can still sell tomorrow. Shadow banks don't need to own your meters to own your morning. They just need your lockbox, contracts that outlive mayors. So let's open the binder that really runs the city, the contract. This is where the lock-in lives. It starts with one line that sounds harmless. The city will compensate the operator for any action that materially reduces revenue. Translation: if leaders choose policy over profit, the budget writes a check. Non-compete clauses do the heavy lifting. Picture a toll road deal. If the state adds a free alternate route or upgrades a parallel highway that pulls traffic, the concessionaire can demand payment. Same spirit on the curb. Remove meters for a bus lane, festival, or outdoor dining, you owe true-up dollars for the hours lost. Governing isn't banned. It's metered. Then there's change in law risk. These clauses price politics. Say a council passes a rule to cap rate hikes during a recession, or mandates a winter shutoff moratorium for water. The operator can file a claim. Your law cut our revenue, pay the difference. Even well-meaning reforms become negotiable cash flows. You can help families, sure, but you'll pay twice, once in foregone fees, again in compensation. Mandatory arbitration is the next trapdoor. Disputes don't play out in public courts. They go to private panels, often in venues chosen by the operator when the ink was fresh. The rules are tighter, discovery is smaller, and the clock is faster. The city walks in with policy arguments. The panel looks for contract breaches and price formulas. It tilts leverage because speed and costs push settlements. Venue selection adds distance. If the contract says disputes sit in New York or London, your city's lawyers now travel to fight about your streets. Local voices shrink in rooms far from the block that pays. Residents show up at council, not arbitration. Meanwhile, meter revenue gets wired while the case drags. Force majeure used to mean acts of God. Now it's a field of carve-outs. Pandemic, civil unrest, emergency orders, operators test the edges. Did closures cut parking hours? Claim. Did curfews lower toll traffic? Claim. Governments assumed shared sacrifice. Contracts assumed cash neutrality. 2020 taught everyone who held the pen. The bill showed up even when streets were empty. Here's a microstory. A mayor rolls out quick-build bike lanes to cut crashes after a deadly month. Paint posts done in weeks. Safety improves. Then legal sends an email. The operator wants compensation for 27 removed spaces on 4 blocks. Price per hour, times days, times escalation. The mayor stares at the invoice and counts which crosswalks he can still afford. The sovereign ceiling sits on top. Cities promise not to legislate around the deal. They agree to treat the contract like senior law. Sometimes they even pledge that future councils will adopt ordinances to maintain revenue. That's heavy. It boxes elected leaders under a document they didn't vote for. It tells voters, yeah, you can elect change, but the term sheet gets a veto. What nobody knew at signing, because nobody wanted to slow the close, is how small choices lock big futures. A definition of material reduction. A formula for fair market compensation. An index for escalators, consumer price index versus a higher proxy. A look-back period for calculating lost hours. Each tiny word turns into real money later. Lawyers write regulatory chill like a footnote. It's not a footnote. It's a winter. If every good idea routes through a damages calculator, bold policy dies before the memo. Staff self-censor. We can't remove that lane. It'll trip a clause. We can't freeze rates. The lender will step up the coupon. That's how spreadsheets beat town halls. Investors aren't evil for using these tools. They're doing their job, protecting yield. The question is, who protects the public's freedom to steer? If the city wants flexibility, it has to buy it up front. That means shorter terms, cleaner outs, hard caps on escalators, and explicit carve-outs for safety, transit, festivals, climate emergencies, and lifeline protections. Write those in plain English. Don't bury them in annexes. Also kill the rush. Holiday votes and 48-hour turnarounds produce bad law. Mandate cooling-off periods, independent valuations, and full contract posting before any vote. Put change in law math on one page the public can read. If compensation is due, show how it's computed. Sunlight isn't theater. It's leverage. One more fix. Align advisor pay with lifetime value, not just closing. If consultants get success fees when a deal signs, you'll get speed over substance. Tie fees to benchmarks, customer satisfaction, service uptime, rate fairness metrics. Make advisors share the ride they sold you. Because here's the bottom line. Contracts outlive mayors. They outlive recessions. They outlive booms. They decide who pays when life happens. If you don't set the guardrails will set you. And every time you try to swerve, someone will send an invoice. The midpoint crisis. Federal money didn't fix the trap. So here's where the story twists. The pandemic hits. Streets go quiet. Meters blink with no cars. Toll lanes empty. Water bills wobble as people lose jobs. Budgets fall off a cliff. Then Washington opens the hose. Relief flows. Cities breathe. Payrolls get saved. Transit keeps rolling. For a minute, it feels like the trap eased. It didn't. The cash was a patch, not a pivot. Relief funds were one time. Pensions weren't. Debt service wasn't. Deferred maintenance wasn't. Most contracts didn't bend. Escalators kept ticking. Change in law claims piled up as emergency orders cut revenue. Operators argued force majeure didn't cover every loss. Arbitrations opened. Even with federal dollars, the spreadsheet fought back. The city's checks landed. The future still belonged to the term sheets. Meanwhile, inflation woke up. Asphalt, steel, chlorine, over time, everything cost more. The consumer price index jumped, which meant escalators jumped too. For tolls tied to inflation, that was automatic. For water and sewer, tariff formulas pitched higher base charges and new capex riders. Residents felt it fast. The bill went up before paychecks caught up. Relief money softened the blow for City Hall. It didn't lower the invoice on your kitchen table. Refinancing got rough. In the low-rate years, governments rolled debt easy. Then rates rose. A city facing a bond maturity had to pay more to roll it. If its ratings slipped during the chaos, spreads widened. Private credit smelled it. Shadow banks showed up with fast money, revenue-backed, covenant-heavy. The temptation was real. Close in 30 days, live with strings for 10 years. Leaders took the deal because payroll beats theory. Private equity had dry powder. Billions waiting for distressed public assets. The sales pitch got a fresh coat, asset recycling. Sell one revenue stream now, rebuild a bridge, fix a park, upgrade a plant, repeat. Unlock value, fund the future, they said. Except the math was the same swap as before. Tomorrow's predictable cash for today's headline ribbon cutting, with escalators and covenants attached. The press conference felt good. The contract would outlast the podium. Let's drop into a room. A coastal city's budget chief lays out options. Pandemic aid closes this year's gap. Next year, pensions climb 7%. A big bond balloons. A water plant needs a new membrane system. A consultant slides a glossy deck. Lease a portion of curb revenue. Borrow against sanitation fees. Fold in a public-private concession on a garage. And boom, $1 billion today. The chief asks about change in law risk, termination fees, and escalators. The banker smiles and says, standard market terms. She knows what that means. Policy will be priced. Inflation didn't just raise prices, it raised conflict. Transit agencies wanted to cut fares to lure riders back. But if farebox revenue was pledged under a shadow bank note, a fair cut could trip a covenant. Legal calls finance. Finance calls the lender. The lender says no unless you add a fee elsewhere. Policy by permission slip. The city wanted to help riders.